Success requires first expending 10 units of effort to produce 1 unit of results. Your momentum will then produce 10 units of results with each unit of effort. Charles J. Givens. And Mr. Givens makes a great point about putting in that effort, particularly at the beginning, where it takes more effort to start figuring things out and learning them. And then as you progress, it gets easier and easier. How do we do that here? 10 to 15 minutes a day. Practice trading with us on the 4 ETFs that we follow. And those ETFs are simple ones. The S&P 500, those 500 big companies that make up the Standard & Poor 500 index. The Nasdaq 100 is represented by QQQ. 20-year bonds that blew it out today, 5.20% up. These are 20-year Treasury bond fund, and gold. It was up a whole lot more for the day and then sort of peeled back. So again, still moving up. We'll go over all these charts, the weekly, the 2-day, and the 4-hour. That is our long, medium, and short chart. What do we see going on with the S&P 500? Most importantly, as we look at the wick on the bottom of the candle, and these are Heiken Ashi candlesticks, solid red means strong down movement. We see the candle body on this week's candle is lower than the prior one, which is good. But what I don't like is the fact that as we look, and I'm going to move the weekly vertical crossover aside, you can see the wick on the bottom of last week, the 28th of February, that Friday. And this week, the 6th of March, we see that the wick on the bottom of the prior week's candlestick is much longer than this current week, meaning we did not plumb the lows of the prior week. Price percent oscillator is heading down. Derivative oscillator is heading down. Those are good things. So overall mood of the market is still quite a bit down for the day, 1.65%. We go to the 2-day chart, and what's nice to see over these past 2 days, that is from the Tuesday-Wednesday candle where things were trying to recover a little bit. And again, I don't want the economy to crash. I don't want the stock market to crash. What I do want is for us to be able to follow the trend, and I want the trend to continue. That's why when I talk about these negative things excitedly, it's because we are practice trading things like SH, which is the inverse to the Standard & Poor 500. We put that in, and you can see it right here. It is SH. It is the short of the S&P 500. And so what happens is, as the S&P is going down, there's another alternative. SH is going up. It's an inverse fund. So just mentioning that as an aside here, what do we see going on? Well, we saw things slowing down in the down movement. They accelerated over the course of the last 2 days, which is good for what we want to see. That is things moving in the direction of our trend. We see, however, that this latest 2-day candle did not plumb the depths of the one that ended on the 2nd of March. That represented last Friday and this Monday. But again, derivative oscillator, which is our leading indicator, and our price percent oscillator, which is our lagging indicator, both are gaining downward momentum. We like to see that. We go to the 4-hour chart, and it just wouldn't cross over for us today, would it? Down in the morning, slow down in the down movement in the afternoon, pushing through the 2-day trend line, but just not enough to cross over going down. So those of you who are waiting to pull that trigger as far as a 4-hour recross really just didn't give that to you, did it? So again, for those of us who are in the down practice trade on the S&P 500, things are still moving along. So we leave the S&P 500 now, and we go to the Nasdaq 100, down about the same amount, a little bit more, 1.69%. We look at this weekly chart, and again, just like on the S&P, we have not reached the down movement we had in the prior week. We would prefer to see a lower plumbing of the depths of movement. That's not happened. So again, things are down. The candle body itself is down. Price percent oscillator gaining downward momentum. Derivative oscillator gaining downward momentum. Still moving down strongly. We see the price percent oscillator on the 2-day chart again cranking over further down. Derivative oscillator also gaining downward momentum. Don't like this candlestick as much as the 3 crows that we saw before with that strong down movement going from the 25th to 27th of February and the 2nd of March. What we have here is a wick on top, which means there was some upward pressure and upward price movement, and it's not a very big candle. Again, didn't go below the prior candle and did not have a low lower than the prior candle's wick, the prior red candle. So again, some slowdown in the going down there. We go to the 4-hour chart, and it refused to cross over also, just like the S&P just won't do it. So we're seeing a little bit of ranged bound movement. We can see where we hit the bottom on the 4-hour chart back on Friday the 28th. Things tracked up for a couple of days after that, then sideways down on Thursday afternoon, really down on Friday morning, bit of a recovery later in the day on Friday, and just not enough to give you a good clean crossover going down. So again, market's trying to keep from crashing over and hammering down again. But the good news is that this 2-day chart is still hammering down big time, and that weekly chart is still hammering down big time. So we'll see just how far things are willing to go. Where might we see if things really started dropping off? They could drop off all the way down to about 184 before we're going to see the Qs actually have some area where you might have some super strong price support. So we'll just watch, wait, and see. We look at the S&P 500 with that same thing in mind. And of course, as we're looking at this weekly chart, we're getting right down at that point, somewhere around the 292 or the 287 mark, something like that. Probably 287 is probably a better mark for where things might be range bound. But we'll see. We start going below that and hammering down, and we are really crushing things. So we'll continue to watch, see the effects of this coronavirus as time moves forward. Now we're going to change things up. Head off to bonds, which blew it out for the day, up 5.20%. And look at how high they went. I saw this morning. It was mind-blowing. Went up to 169.33 at one point. Just incredible. We see that our weekly vertical crossover, what a good one that was for us. We've only had one slowdown candle in the last 5 weeks. And of course, the price percent oscillator spiking up like a hockey stick, derivative oscillator gaining upward momentum, just moving, blowing through the Bollinger Bands and everything. It's really hammering up. Go to the 2-day chart, and you also see another hockey stick. I mean, right there over the last 2 days, particularly with that high at the 169.33 mark. But derivative oscillator moving up like stair steps, price percent oscillator moving up. And we go to that 4-hour chart, and again, just continuing to see lots and lots of strong movement. Look at that jumping in point back on the 18th. For those of you who jumped in at that time around 146, up to 169 at one point. That's just incredible. And that is since just the 18th of February. Now remember, where does the money go from the stock market when things are looking bad? Typically into bonds, and as bonds continue to just hammer up, that shows you where the money is actually flowing into, out of the market into a more safe haven like bonds. So we'll just continue to watch, see what there is to see there, but that has been a beautiful, beautiful practice trade so far. Lastly, we go to gold. Gold disappointed me a little bit today. It was pounding up to begin with. Gold throughout the course of the week hit a high of 159.25, and we see the price percent oscillator is spiking up nicely. Derivative oscillator, that is a leading indicator, still losing some momentum there. And that's partly due to the fact that we've got bottom movement on our Heikin Ashi candlesticks, not just solid green with only wicks on top, but these wicks on the bottom are showing you some weakness. That's reflected in the derivative oscillator continuing to lose energy. But that all-important price percent oscillator is heading up quite nicely. Good to see that. 2-day chart, it bounced, of course, off that red signal line on the 2-day chart, followed by, after a big down candle, that was for Friday and Monday, Friday of last week and Monday of this week. And then, of course, the Tuesday, Wednesday candle was a green spinning top showing you indecision. This latest candle is a nice, strong up candle. Derivative oscillator, however, we've talked about is still negative, but that price percent oscillator is pulling away from the red signal line. And last we go to the 4-hour chart. And, of course, we had that 4-hour crossover in the afternoon on Wednesday, the 24th. Some of you on the 4th, of March. We see after that we have had 2 days of okay movement, again hitting a higher high at the end of the day on Friday, which is good to see as far as the wick on top. Derivative oscillator gaining upward momentum, price percent oscillator heading up. So again, even with some of those inherent weaknesses we're seeing in the bigger charts in gold, it's nice to see these last 2 days of the week giving us some up movement. But again, be careful with gold. Continue to watch some of those anomalies we're seeing on that weekly chart, and particularly the 2-day chart are somewhat concerning. But again, the number one winner that we have seen for the week, and heck, for the month, and maybe for the year so far, is of course these 20-year bonds that just continue to blow it out. So again, keep your eye on these charts. Remember, overall mood in the stock market, quite negative. The mood in gold is a little iffier. It's heading up, but again, hesitatingly so. And we see bonds just blowing it out. That's where we are, my friends. Hope that you are learning a lot from all of this volatility. I want you to be practice trading. I want you to be taking your notes, filling out your daily market worksheets. Great training for you in today's show notes. It is on the weekend or the Monday effect. It's called both. What is that about? It's all about news toward the end of the day on Friday, carrying over with stock price movement, good or bad, into Monday or so of the next week. We see it happen again and again and again. It's one reason our weekly vertical crossovers, remember our buying points are Friday afternoon on those, they tend to work over and over and over again because that massive movement and that feeling and psychology in the marketplace of either good or bad news transfers throughout the weekend and builds up for more movement in that direction on Monday, invariably, particularly when you have a weekly vertical crossover on our price percent oscillator. Want to know what we do here at chartingwealth.com? Go to the channel, sign up, put in your email address and your name. You'll get the daily market review in this once-a-week comprehensive review and forecast, plus those special trainings every day. Appreciate all of you who purchased our book and all of our Patreon supporters. Patreon supporters, don't forget, live Q&A call-in this next Wednesday, 12:30 Eastern Daylight Time. Don't forget, your clocks change over the weekend. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters.